When you think about the most powerful companies on the planet, Alphabet, Google's parent company, is always part of that conversation. But for investors, there's a really important question we have to ask. With its huge scale and really unique structure, is the business actually getting stronger? Well, today, we're going to break that down.
All right, let's just jump right in with a question that trips up, well, pretty much everyone when they first look into this. You decide you want to invest in Google's parent company, Alphabet, and you see two tickers, GOOG and Google, and the price is almost the same, they look identical, but there's a massive difference, and it gets right to the very heart of how this company is run.
So here's our roadmap for today. We're going to start with why Google even became Alphabet to begin with. Then we'll solve that two-ticker mystery. After that, we'll dig into the incredible power that structure gives its founders, look at the hard financial numbers to see the results, and then we'll wrap it all up with what it all means for you as an investor. Okay, first up, let's talk about Alphabet's origin story. You see, to really understand its strength today, you've got to go back to 2015, when Google decided to completely reinvent itself. And you know, this all happened incredibly fast. The plan was announced in August 2015, and by October, boom, it was a done deal. Google, the giant we all knew, was now just one part of a new parent company called Alphabet. And here's a really critical detail. Even though founders Larry Page and Sergey Brin stepped down from their day-to-day roles in 2019, they remained controlling shareholders. Remember that phrase? It's going to be very important in a minute. So, why would they do all this? Well, according to co-founder Larry Page, the main goal was just to make things cleaner. The core Google business, we're talking search, ads, YouTube, was just getting so massive that it was tough to manage alongside all the other wild long-term projects they were working on. This move was all about creating focus.
And this slide just perfectly lays out what he meant. Alphabet became this collection of different companies. On one side, you've got the absolute cash machine that is Google. But on the other, you have all these futuristic, high-risk ventures they call other bets. You know, think self-driving cars with Waymo, drone delivery with Wing, or even life extension research with Calico. This new structure let each one operate on its own, with its own leader.
Okay, so now we get why Alphabet exists. Let's circle back and solve that mystery from the beginning. Those two tickers. Because this isn't just some weird little quirk, it's the entire mechanism that allows their strategy to work. So the key idea here is something called a dual-class share structure. And in simple terms, all it means is that not all shares are created equal. Some shares get way more votes than others. It's basically a way for founders to sell stock to the public to raise money, but without actually giving up control over the company's direction.
And this is where it gets really fascinating. Alphabet doesn't just have two classes of stock, they have three. So let's break this down. First, you've got Class A shares, that's ticker GOOGL. Pretty standard, you buy one share, you get one vote. Then there are the Class C shares, ticker GOOG. You can buy these too, but they come with 0 votes, none. And then you have the powerhouse, Class B shares. These are held privately by the founders and insiders. And here's the kicker. Each one of those shares gets 10 votes.
And this is the result. This is the whole point. Because of those Class B super voting shares, the founders control more than half of all the votes in the entire company. And they do this while only owning about 9% of the actual stock. So what does that mean? It means on any issue that comes to a vote, whatever they want happens. They simply can't be outvoted. Now, this kind of setup, this level of founder control, is, to put it mildly, pretty controversial. And it really sparks a debate about what's actually best for a company and for the people who invest in it. So let's take a look at both sides of that argument. On the one hand, people who support this say it's a huge advantage. It lets the company focus on a true long-term vision without having to worry about Wall Street's short-term demands every quarter. It's what allows them to pour billions into those moonshot projects. But on the other hand, critics will tell you it's just not fair. It's undemocratic. Public investors are funding the whole operation, but have basically no real say in how it's run. And here's a fantastic summary of the pro argument from Investor Online. The thinking is that you're really just investing in the founder's vision. And this structure protects the company from chasing short-term profits, and instead lets them focus on long-term innovation.
But here's the other side of that coin put just as clearly. It just feels unfair. The company gets all the cash and benefits of being a public company, but the investors who provide that cash get none of the influence that usually comes with it. It's a system that just funnels all the power to the top.
All right, so we've got this unique, kind of controversial structure that's built for the long term. Now for the most important question of all. Does it actually work? Let's stop talking about theory and start looking at the numbers to see what the results have been. Well, the revenue story is just staggering. I mean, look at this growth. From $136 billion in 2018 to $257 billion in 2021, and now hitting an incredible $350 billion in 2024. This is not a company that's just growing. It's a financial juggernaut that's still accelerating.
And this isn't coming from just one place. It's the continued dominance of search, massive growth in YouTube ads, and Google Cloud becoming a real force. And all that money coming in the door is flowing right down to the bottom line. Net income, that's pure profit, has more than tripled over the same time, crossing the $100 billion mark in 2024. The core search business is so profitable that it funds everything else, and now even the cloud business is starting to contribute in a big way. I mean, it's profitability at a scale that's honestly hard to wrap your head around.
And as you can imagine, the market has definitely taken notice. Earlier this year, Alphabet joined this super exclusive club, becoming just the fourth company in history to be valued at over $3 trillion. You just don't hit numbers like that unless investors have incredible confidence in your business and its future. Okay, so let's tie this all together and finally answer that big question we started with. We've seen the unique structure, we've looked at the debate around it, and we've seen the incredible financial results. So what's the final takeaway here?
Well, the strengths are pretty undeniable, right? They have an absolutely dominant position in search and digital ads. Their revenue and profits are just massive, and they're still growing. That corporate structure lets them make huge, patient investments in the future, like AI, and all of it is built on top of a balance sheet that is basically a financial fortress.
But of course, there are always risks to consider. That founder control is a real double-edged sword. It's amazing when they make good long-term bets, but it's a huge risk if they make bad ones because nobody can overrule them. They're also facing constant regulatory pressure all over the world. Competition in AI and cloud is absolutely fierce, and at the end of the day, their main business is still heavily tied to the health of the ad market.
So let's go back to that original question. Is Alphabet's business getting stronger? Honestly, the numbers really do speak for themselves. The evidence we've seen today strongly suggests that it's very specific, and yes, controversial. Corporate design has been the engine that built one of the most powerful and financially sound companies in the world. The strength isn't just in the balance sheet, it's in the very blueprint that created it.
Learn, invest, repeat. Investing made understandable.